Welcome back to Let's Talk Tax. I'm Dave McGuire. Today we're recapping a season that gave property owners more to work with than most, the 2026 property tax appeal season. Today we're breaking down what actually happened this season. Which states saw the biggest movement, what worked when clients did appeal, and what CPAs should be doing differently heading into next year so this isn't a once-in-a-decade conversation with clients. Joining me today are two members of our property tax team who were in the middle of it all season, Rebecca Patterson and Kyle Gaddis. Rebecca, Kyle, welcome.
Thank you for having us.
We saw these changes this year, and obviously it's been a year, it's been in the news a lot, whether it be, obviously, we hear about it in Texas, or they've been pushing for it. In Florida, they've been going, well, we got to get rid of residential property tax. So we all know it's an issue, but what was really driving this change that we saw this year, that caused people to really have this affect them probably more than it has in the past?
Yeah, so Dave, it's really, for a lot of people, you think, something happened with my property. I had a high vacancy in my property or some damage or those type of things. But to your point earlier, it's really just about the fact that these jurisdictions are using these mass appraisal systems. They're applying these blanketed kind of assessments throughout everybody, and they don't necessarily know the property itself. So, as you look through those properties and you actually look into them, dig into them a little bit more and ask the why question, you realize that, there's more to it. And if you actually ask the question about, what had changed with the property, did there anything change at all? You have a really good opportunity to speak with the assessor and see if maybe those valuations could be changed.
So we hear about the valuations, and obviously I know we talk a lot about business, but I always try to equate it to whatever I deal with on a personal level. And I get my new assessment and I go, wow, my home went up in value. And so I get really excited about it. So you're saying that maybe it didn't go up in value as much as they said it did on that assessment. Why does that matter? Why does the value matter? And why would I want to argue my assets are worth less?
Yeah, well, really, that's what the assessors, a lot of times you hear the connotation is my property tax needs to be lowered. Why are my taxes so high? But the way it's done is that all taxes are based on your assessment and what your value is. So that is really the lever that pulls and makes those tax liabilities change up or down. So the lower your value, the lower your tax liability is going to be.
If it's based on the value, how do the change in interest rates and rising cap rates and other things, how does it affect the valuation of properties?
So the rising interest rates did not necessarily cause the higher assessments. What that is exposing assessments that didn't necessarily previously catch up to the market conditions. So the higher financing costs that property owners are seeing now pushes the investor return, right? Mm-hmm. So your cap rates are going upward. The higher the cap rate, the lower the value is going to go. But it's that adjustment that wasn't previously accounted for, not necessarily the rise in the interest rate. It's catching up with the market condition.
Were we seeing this change occur more in certain areas than others? Was it universal? If obviously, let's say I own some rental houses, or I own a strip mall, or I own an office building, is it certain areas that tend to be assessed more than others, or have this change affect them more?
It is definitely not universal, right? It is jurisdiction dependent. It is area specific. It is state specific. And a lot of it has to do, on one hand, with market conditions, of course, but on the other hand, different legislation in those jurisdictions, be it on the local level or at the state level.
As you think about it, as offices, everybody went through COVID and now we're in that post-COVID world, and it still really reframes everything that we do in life, especially when it comes to office, right? Everybody, the remote work process, every office square footage was reduced, and then all of a sudden now the pendulum's starting to swing back the other way, and people are coming back to the office, but are they using the office in the same way, the same square footage, the same footprint? So, that impacts occupancies, vacancies, and that's going to impact the value. If an investor is going to come in and buy that office property, they're going to say, well, what's your vacancy? How much income is that property producing? And if it's not producing the same amount or the same type of income, that's going to impact the value of that asset.
So when you're arguing an assessment, so let's say I have a client and they say my property tax bill is too high. And you're arguing assessment. So you're just looking to lower it because you don't get to argue the percentage that they're charged as of their assessment in terms of property tax. You can just lower the amount. So they're charged 2% and their value is $1 million. You want to get that lowered because you can't touch the 2%. You can just touch the $1 million. Is that correct, or is that a good way to look at it?
Yeah, that's a good way. As much as I would love to be able to walk into some place and say, I can lower your taxes, I don't have that power. I can't say, hey, something's going to be taxed at a less percentage.
Yeah.
But we can definitely say we can lower the value and to look at lowering the value of that asset, and that percentage will be based off of a lower number. And that will, in part, lower your tax liability.
We would be heroes if we could come in, lower your assessment and your tax rate.
Kyle, you mentioned just a minute ago that office vacancies and other things. Is that universal? Are you seeing certain areas where office vacancies are higher or lower? Like, are they higher in cities versus suburban areas or anything like that? Or is it pretty much, if you've got an office, there's probably issues with vacancy?
Yeah, there's definitely all over. So, there is a little bit of, as you see people kind of depart from downtowns and be more rural and suburbia, that population shift is, vacancy is obviously trailing that. But, even in the rural areas, there are some vacancy offices that, it just doesn't fill up the way you would think it would. And it's evolved, right? It's been kind of a trickle down effect over the years as populations shift. There's been, more and less vacancy, that has kind of followed those populations.
And to the previous point, post-pandemic vacancies are just lower. I wouldn't say across the board, but I would say it's definitely something that we're seeing. So your leasing costs, your weak transaction activity, that all changed the way the assessments are playing out.
Obviously, we work nationally. We're up here. Kyle and I are both based in Indianapolis. You came up to visit us today. We appreciate that, from Texas. So let's kind of talk about a couple states. So, and this really, Indiana, close to home, that's what affects me the most. But what were some reasons that Indiana kind of stood out this year?
Yeah, so Indiana is one of those states where, as we were talking about earlier, a lot of states are, I don't know if catch up is quite the right word, but as market dynamics shift, I guess, is the best way to put it. They're playing catch up with some of their cost tables, some of their data, some of their sale metrics. And those things are starting to hit in Indiana. And our main state regulatory body, the Department of Local Government Finance, which controls all the assessors, they increased their base rates and their cost tables this year. And I'm sure, as everybody's seen in Indiana, the commercial rates across the board, across the state, rose about 15%, all the assessment values. Manufacturing, about 20%. So, that sector is definitely feeling it in Indiana. And it's just a good example of, how just it doesn't not just impact a locality or a county. It's all across the state.
Mm-hmm. What about other states? What about North Carolina?
So North Carolina became kind of a moving target in 2026. Initially, 12 counties were conducting their 2026 reappraisals, but legislation that passed June 19th required 9 counties to continue using their previous appraisal values until 2027. So the broader lesson there remains that the earlier you are looking at these values and looking at these assessments ahead of the appeal deadline, the better off you're going to be.
Is there a limited window where we saw that, or is 2027 potentially going to be a good year to look at North Carolina again as well?
2027 is definitely going to be a good year to look at your assessments.
Okay. Are there any other states that, while we're kind of talking about the states, that either of you want to highlight, whether it be Texas or Florida or Michigan or Virginia, or if you want to bring up New Jersey, that's fine. That's where I'm from, but I don't know that we want to talk about New Jersey today.
We don't want to talk about New Jersey. But Texas is always worth flagging, not only because that's where I'm from, but they reappraise every January 1st. So the process there is a lot more streamlined statewide rather than the jurisdictions kind of, again, being a moving target like a lot of states. The bigger thing to note is that the burden of proof is on the appraisal district to justify those assessments and those market values. A lot of states, the burden of proof is on the petitioner. So Texas is definitely a contrast from North Carolina in that way.
And I'll point out Iowa. Iowa's, we're talking a little bit about reassessment cycles and those sort of things. Iowa is in 2027, they're going to be coming out with their new values. So they do it every 2 years. So 2026 was, I guess, a kind of a quiet year maybe for Iowa in a little bit. If you missed your first window in 25, well, now we're circling back around, and 27 is going to be a good year. So, if I'm in Iowa, I'm saying, hey, okay, what's maybe changing? My value is definitely going to change, and it also amplifies the importance of, if you miss an appeal window, you're going to possibly miss out on 2 years of tax savings, because if you catch out in the first year, that value is going to stay the same for that second year. But if you don't, you may only have 1 year of savings.
And to piggyback on that a little bit, there are some states, New England states, I'll go further north than New Jersey, so we won't pick on New Jersey, but some of their cycles are 3 years or even 5 years in some cases.
So one thing I wanted to question, you mentioned it just a minute ago, Rebecca. I think you said Texas, the assessments from January 31st?
January 1st.
January 1st, okay. Are most states January 1st? Because you were mentioning earlier when we were talking about offices, we were talking about vacancy. And obviously that can be a floating metric depending on the time of year. Is it always January 1st, or are certain states different times? And does it matter if, take Texas, let's say I have a large tenant that walks away from their lease on November 1st, and then I refill that building in March. Does it matter that I basically had no tenants on January 1st, or am I looking at a red herring?
It does matter. Taking your example of Texas, the condition, state, status of the property as of January 1st is what prevails. So if you had tenants that moved out November of the previous year, it was empty January 1st, you got tenants in March, doesn't matter. You will then appeal that status for the next cycle, assuming you still have those tenants in place. So the status of the property as of January 1st is what matters. If it was January 2nd and the place burned down, that doesn't matter. You have to fight that next year. With that said, January 1st is not the date for all states and all jurisdictions. Again, moving target is the is the phrase of the day here. Every state is different, and even a lot of counties are different. Georgia, for example, I can't tell you how many deadline dates there are in Georgia, depending on county.
Just kind of thinking in my head as people are going through renovations, as they're changing buildings, is that something they should take into account, the effect that it could have on the property tax based on when they have tenants moving in or out, or if they've got a tenant that they know is vacating and they plan on getting a new one? Sounds like they can almost, if they know how these things work and they've talked to one of you, they might have a conversation about, okay, how important is it if we have one lease that's expiring at the end of November, do we sign that new lease till February 1st, or do we adjust it to make sure that we meet those criteria?
Yeah, it's a very good point, good call out, and a good consideration. I think, those type of things, those are the nuances that you can really do some serious property tax planning that can have some major contributions to help lower that liability, because that's going to paint the picture that the assessor is going to see is that, hey, if this rent roll has 10 leases falling off of it in November and we value it at January 1st, to Rebecca's point, that's when you're valuing it. And if you have that much vacancy, that's what they should be basing their valuation on.
Now, obviously, as somebody that comes from the depreciation side, then we change it because we're all based on placed in service. So maybe we might have conflicting areas, and then we'll just butt heads as to who gets to save them the tax side. Here you go.
Yes.
But so this season, let's talk about things that you saw that worked this season, things that you didn't. So as you were going through the property tax appeals, were you seeing most of your cases going to formal hearings, or did they get resolved earlier? How did that process work?
We always try to settle informally, as we call it, and not escalate to the formal level board hearings. As often as we can, that's going to be the better way. We work very hard to build relationships with the assessors and the counties and those different jurisdictions, so we can go to them and say, listen, this assessment went up 20% from last year. Let's talk about this. They tend to be very receptive more often than not. The problem becomes timing. You have a small window of time to go to the assessor when you file the appeal to settle that out just one-on-one, right? After that, you're forced to go to a hearing and you're presenting your evidence to a board or a referee, or depending on the state and jurisdiction. That's going to be more often than not a 3-person panel that will decide your case. You would rather settle that out. So I wouldn't say that the majority of our cases are settled out informally, but that is certainly what we try to do. So that's where it becomes very important for our clients to, once they get those notices, send that in to us. Start looking at that when you get the notice. Don't just focus on that appeal deadline.
Yeah, in certain states, to piggyback off that, certain states have very formal, informal time periods, right? But every state is going to, once you get that notice, if you reach out and engage them, it's amazing. Even if it's kind of a fact finding, you may not even go into it with much information, but the assessor will kind of let you read the tea leaves and give you the kind of some hints of maybe how they're valuing it and how you can prep your evidence. And we go back to the client and say, hey, maybe if you have this piece of evidence, a little bit more targeted, we can strengthen their case and provide a better value for them.
Or on the flip side, we get a tea leaf of what the assessor or that county has with regard to their evidence that we may not have known about.
Sure. Yeah.
So when we're going through this, what kind of results do you typically see? Or do we have a standard of this is where we've been getting reductions, or is it all across the board?
It's really going to be all across the board, right? I mean, we have a certain number, and we have about, we look at around 10% as kind of a starting point, but, it's very, very dependent on the type of evidence, on the type of property, on the jurisdiction. So, the targets are going to be really dictated by the evidence we have. So at the end of the day, we're looking to provide maximum value for that client, and depending on their tax exposure, what that looks like.
Yeah, and to that point, saying we kind of start out at a 10%, there are plenty of times that we've gotten around 10, 15%. Okay, great. We've gotten 40 to 50% reduced before, and then there are times we've gotten 2 or 3%. So, you're still getting that reduction, but it can vary greatly to the range of reduction you can get. And that's where, getting the full scope of the status of the property and the conditions is going to be very helpful.
And I've got a great example of that, and it's a little bit of an extreme example, but it's in Kentucky. There was an apartment complex where we talked with the client, and they just purchased this property, arm's length transaction, and the assessor put that value right on the nose of that sale price. And it wasn't about 3 or 4 months later that we found out that there was the major employer in that community went out of business, and that landlord got about, I think, 30 or 40 notices that their tenants were going to be leaving. So, we took that information and went to the assessor, and we got, I think it was about a $20 million reduction in value. And again, that's an extreme example, but that's just to your point earlier, Dave, about vacancies and those dates and when they hit, it can really provide a significant value. And it wasn't, that difficult of a case, right? Once we present that to the assessor.
That brings up an interesting question. If you're sitting there, let's say I own a manufacturing business, and I did just go through layoffs. And because of that, my values have probably dropped. And now I'm sitting there and I want to get reassessed. Is this stuff that is, obviously it's going to be printed in the rolls, but does it get published much elsewhere? So am I upsetting the community if I'm pushing for a lower valuation? Is it getting that bad press? Because I know there's sometimes those manufacturing businesses, if they're the main employer in a county, they lay people off. It's a good time to maybe reassess, but do they ever fight that backlash?
Yeah, so I've got 2 points on that. So the first one is we have to be careful, and the assessors have to be careful to be valuing the real estate and not the business. So just because you're having layoffs may not necessarily mean that the real estate, the cost to operate that real estate, that net operating income of the real estate has changed. So yeah, it's certainly a consideration, but those are sometimes assessors go the other way and they value a really well-run, well-operated business. They value the property higher than it should be. So that's the one point there. And then the second point is really it's you just have to be careful about how you go about kind of ciphering those two off. I mean, does that make?
Yes. Yeah.
So.
As we're talking about valuations, obviously, and I'm simplifying because I'm not a property tax person, but when I think of valuations, I think of income approach, I think of sales comparable, I think of cost approach. Is there one of those approaches that you saw more weight associated with when it came to valuations, or one that you saw more realized returns?
So for stabilized income producing properties, the cost approach is going to carry the most weight and benefit, right? When you are analyzing the property level income, occupancy, cap rates, all of that, that definitely bears a lot of strength and importance when you're arguing that case. With that said, some jurisdictions don't even recognize the income approach. They say we did our assessment based on the cost approach, and that's just what it is. And so if I'm not bringing an argument with a good argument on the cost approach side, they're not going to listen, or I have to escalate it, right? But mass appraisal, IAAO standards indicate that you should be equally weighing out all three approaches for commercial properties. Some jurisdictions just don't play by the rules, so to speak, and some of them will weigh very heavily on the sales market approach, to the point that they require you to submit sales comps, and we really have to mitigate that risk at that point, right?
Where they do accept the income approach, what happens if it's self-rental and you've controlled your own rent? So in other words, let's say I own a warehouse. Market says that warehouse can bear X dollars per square foot, but I'm renting it myself. So I get to choose. Now I can't go too high because there's restrictions on that on the federal side, because that could get around. But what if I charge myself less rent? Is there an argument, because I've got my real estate, I set up my own lease with my operating entity and my real estate entity. Can I set the rent lower and therefore lower my valuation on an income approach, or would that be seen as fraudulent or difficult to argue?
Most of my experience has been that, at least with our clients, that the leases are self-controlled inter-entity leases. Some jurisdictions actually require those leases to be on file with them, so it's not something you're going to be able to hide. Most of the counties generally are understanding of the concept, and what we do then is bring the market analytics of what price per square foot, cap rates, and all of that would be for the rents. And we have pretty good success with the jurisdictions accepting that and not really drilling down on the self-controlled rents, with some exceptions, of course. But it's very common to have that, and we do rely on the market rents in those cases.
Yeah, the assessors are going to treat that probably almost owner-occupied in a sense, right?
Exactly.
I mean, because that's, those related entities, it's not arm's length. So to Rebecca's point, they're going to look at the market.
Okay. So where did you see people making mistakes this season? What were some of the areas that you just saw owners or their CPAs or somebody just missed the boat?
Do we have enough time? No. I would just say not acting early enough. Again, we want to be proactive, not reactive. Instead of focusing on the appeal deadline date, we have until May 15th to file this, we really want to be seeing what the assessments are when the notices go out. A lot of times that's publicly distributed, right? We can find that out. But there are many jurisdictions that we deal with that we don't see those notices. They are a moving target on when the notices go out. So it's very important for our clients to send us those new notice values when they get them. That is the biggest mistake we see. A week or 2 days or even 1 day before appeal deadlines, we see a lot of clients sending us, oh, can you help us? And a lot of times that's too late, unfortunately.
Yeah, and to your point earlier, Dave, the value is important. A lot of times they may wait till the tax bill comes, and oh my gosh, the tax bill. Well, the tea leaves. You got your warning signal probably a year earlier with that assessment value, and that's the opportunity to really get out in front of it. And to Rebecca's point, start that conversation early.
Well, as we wrap up, a couple real quick questions. So we talked about it, and we see it. I mentioned my property tax appeal. I'm assuming, or my property tax valuation. I'm assuming that's not worth pursuing. At what dollar amount does it start making sense to bring someone like yourself into the equation?
So in general, our screening benchmark is going to be a $50,000 or more tax liability per single property or single asset. That's just a guideline. That's not our hard and fast rule, right? We are very much considering the likelihood of getting the reduction, first of all, but there are jurisdictions that can counterclaim as well. So we are going to mitigate that risk for the client as much as we can and really take a look at that. What makes us unique as a firm at McGuire Sponsel is that we do account reviews ahead of time to look through and say, hey, you're in a jurisdiction where the school board is very aggressive and might come after you and increase your value in some cases. Let's look at this, pause, and we're unique in that we'll be very honest with you and say, you know what, this is not going to be in your best interest.
CPA firms, I'm going to combine actually what's listed as two questions here, but as we're looking at CPAs and how McGuire Sponsel can help, how do CPAs build this into their conversations, and where do we come into play as it goes through that? Because a lot of the people that listen to this are not the building owners, but they're the accountants that work for them. So how do they build this in, and then where do we come in to help with that?
Yeah, I would say it needs to be part of the annual exercise of evaluating their whole portfolio and working with that client. It's a bill that's going to come up every year, and it's an assessment that's going to come up every year, and it's an opportunity to, talk through, hey, what changes to the property occurred? Were there any acquisitions? Was there any damage? Just those sort of conversations, they'll lead to good things that can be found out about the assessment.
So as we're wrapping up today, do either of you have any closing thoughts you'd want to leave CPA firms or their clients with as we kind of walk away?
For me, I'm just going to reiterate, be open to sending us rent rolls, P&L, income and expense statements, those types of documents. We do get resistance, and rightfully so, from CPA firms not wanting to share that documentation with us as, client confidentiality and all of that. However, it's in their best interest. It really does help us make a better case for that individual property. And again, to reiterate, we need to be more proactive and not reactive. So not waiting until that appeal deadline is going to be in their best interest.
Yeah, and I would take maybe a higher level view of all of this. There are some offices and some assessors, to your point earlier, Dave, about should you even be challenging this? What's going to happen if I challenge it? Are people going to be mad in the neighborhood or mad around the block? There's a sense, and I've read this, and I firmly believe it. It's a checks and balances. The really good assessors, they'll talk about how important it is that they get it right.
Mm-hmm.
That they're basing their taxes and people's money off of this, right? And the local communities use property tax money, so it's a very important tool, but it needs to be fairly assessed. And if the property owner is doing their due diligence and looking at the property and making sure that it's, they're basing it off of the right reasons for the assessment, then the assessor is going to make that change and make sure that it's being changed.
Well, it's interesting. I know a lot of CPA firms that we work with. It seems like this is the one area of tax that they don't want to touch. Mm-hmm. And it's a big pain point, as noted by what's been in the news this year, mm-hmm. is it's a big pain point. So I would just recommend people reach out, even if they don't know, mm-hmm. reach out to one of the two of you just to talk about it, because we know that it's a big pain point, and the clients may have the expectation that the CPA is involved in it, but the CPA really doesn't understand it, so they're keeping it hands off. So I appreciate both of your time today. It was nice talking to you, and I know I learned a lot about what you do on the property tax side. Hopefully some of the listeners did as well. So thank you for your time today, and thank you for joining us.
Thanks, Dave.
Thank you, Dave.